Hi, everybody. So we've got some people already in the group, in the live chat, and for anyone that's watching the recording. So Frankly Finance, we are at week 24. Next week's going to be the last week. So depending on how this session goes, we may actually be doing a part 2 next week. We'll work it out at the end. We might get everything covered. So today we're going to be talking about investing basics. So we're going to be focusing around investing in equities, shares, that asset class, but we'll probably go through a couple of comparisons and different stuff anyway. But yeah, the main thing about is investing basics, kind of what are the things that you need to consider and where to if you're interested in getting started with investing. Lexi, anything to add on what you think we'll be talking about today?
My brain's not working today though. So talking about investing, this is something that comes up with clients that I talk to as well. A lot of them aren't necessarily in a position to be investing right now, but I think it's always important to understand investing and know what else you could be doing with your money, because it makes it a little bit harder then to waste money. So coming back to like cash flow and budgets and things, you don't necessarily have to have a budget. If you're very focused on like long-term goals, it's a lot easier to spend intentionally and mindfully and not have to worry about a budget. So I guess this is an alternative. Does that answer your question?
Yeah, I think lots of people at the moment, because of social media and stuff, they hear how much other people are investing and they think it's something that they should be doing and it's something that they're interested in. But there are other things that you need to, like the foundations, the fundamental stuff, like managing your cash flow. You might not have a budget, but just spending less than you earn. You know, if you've got debt, having a debt repayment strategy, knowing what your goals are, having an emergency fund, stuff like that. So there's things that you've got to get like your ducks in a row before you start investing, but you could always be learning about it, because then the learning curve when you're in the position to do it is not going to be as steep. But the other thing I always say to people is, like, people go, oh, I want to be investing or whatever. If you've worked in Australia and you're over 18, you are an investor. You've got a superannuation.
I was just going to say that.
Are an investor. So if you want to be learning about it, there's podcasts and webinars and all of that kind of stuff, and there's books, and just make sure you're getting the information from the right place, but also take an interest in your superannuation, because that is an investment portfolio. The only difference is it's in a trust, it's a different tax structure, but how the shares work in it, how the funds and everything, it's exactly the same as what you could be doing in your own name. So you're already an investor, so you've already like jumped off that ledge. So you can take a note, like an interest in that, and be learning from that as well.
Well, it's a big part of, 10% or more than that now is going into an account. Like if someone was to take that much of your income every single pay, you should be interested in it.
Yeah, you definitely want to know where that money's going. And I guess that's an interesting topic then also to go, well, if we're already investors in super, why should we be considering investing outside of super in like shares and things that we're going to be talking about today? And that's so important because, as we know, superannuation has a preservation on it. So there are government restrictions on what age and what circumstances that you can access it. For most of us, it's over 60 or it'll be 65. So that's a long time away. Whereas having an investment portfolio in your own name or whichever structure you choose that you have control over means that if you want to retire early, so you might want to retire at 50, or something goes wrong and you need access to that, or your goals change and now you want to take your investment out to buy a property or whatever, you have control over it, whereas with superannuation you don't. So a lot of people, I'll see, like when I gave financial advice, if their superannuation was set and it was going to be what they needed, then we'd look at investing outside, even though it wasn't the most tax effective option that they had, but it gave them choices. So it was another reason. So building wealth, something that they could tap into or earn income that was totally controlled by their own, time frame, not the preservation of super.
Yeah. So coming back to super, I always hear people whinging, particularly on social media, about, this is just one example, the big profits that the banks are making, and they're really upset about that, not necessarily realizing that they are benefiting from that because they are invested in those banks within super, typically. Because if you've opted for like the default investment option within super, I would almost guarantee that you're going to be invested in companies like this. So I've just pulled up a random super fund. This information is readily available to you. You just need to know where to look. So with whatever funds that you are in, you might be in the blah, blah high growth or the blah, blah growth or some type of name for your particular investment option. You may have one investment option. You may have many. Typically, if you're in the default, you're in one, but it is very diversified inside that fund. We're going to talk about diversification today, but basically not putting all your eggs in one basket. A lot of super funds are invested in shares, including Australian and international shares. This particular one that I pulled up, I've just ordered it from like the biggest investment of shares to the smallest. So we'll go through a couple of those. So the very top investment is in BHP. So if you had some kind of a problem with BHP, you might want to review how your super is invested, because where we invest our money, like we are supporting this. So the BHP is probably a bad example. The next biggest one was Commonwealth Bank. So when you hear that they have made billions, probably, is it billions or trillions? That was a huge number this year of profit. You are benefiting from that. The next one is CSL, which is a medical company. They do like cochlear implants and things like that. Microsoft Corp, National Bank, Amazon, Woodside Energy, Woolworths, Macquarie, Wesfarmers, like these are household names where you are invested in these companies and you may have just not have realized until today. Let us know in the chat if this is like new information to you or if this is something that you already knew. We have had just a question come through as well, Gemma, in relation to slight sidetrack, not necessarily talking about investing within super, but what if you have a mortgage debt? Should you pay that off first before investing outside super? Because that could take years to clear. What is your answer to that?
I think a very old school approach is you should have all of your debt gone before you invest, but I don't agree with that. So I think if you're managing your cash flow well, if you have a debt repayment strategy, so even if you have high interest debt, like yes, you should get rid of it, but if there's a reason you should hold it, and we've done an episode about this before, about like, yeah, so if you have a car loan or something that's got high interest, but there's no benefit to paying it out because you're going to pay the same amount of interest, whatever. So I just think if you've got a debt repayment strategy, you're comfortable with the repayments. If it's a home loan, it's not tax deductible debt, there's probably a way you can structure it. But these are long-term debts, and the longer that you put off investing, you don't have the compounding interest effect. So it just really depends on your situation and your goals. And maybe, again, the super one, maybe you don't need to be investing outside super. You should focus on your mortgage because you're closer to retirement and all these other things. There's just so much to consider. But yes, I don't have a hard and fast, but I just definitely don't agree that you should have all your debts gone and then invest. I think that there are ways that you can do it while you're paying down debt. But what do you think?
I think we have spoken about this in a previous episode. So if you haven't listened to our previous episodes, maybe go and have a listen to those as well. But something that I talk a lot about that I notice a lot of people are like, aha, is in relation to, if you think into the future, okay, your mortgage is cleared, and so suddenly you have $2,000, $3,000, $4,000 a month potentially to do something else with because you're not paying that debt off anymore. How would you feel going from basically 0 to 100 overnight, going not investing at all to then suddenly investing what one would regard as a significant sum of money? And so that can feel really, really uneasy. So it's not necessarily going to be for the compounding impact, because there's compounding, I guess, within debt as well. But it's about putting your, toe in the water and getting a good feel and understanding how things work and being able to ride out volatility. And these are some of the things we'll touch on either today or next week. So I hope that answers your question, that there is no one size fits all. You can come up with different things that you do. It might be all of your surplus throughout the year is directed to debt, but then if you get a Christmas bonus or with your tax return, maybe you can kind of earmark that as this is my investing money. So yeah, no one size fits all. so many different ways to do it. But I think the most important key takeaway from today is start to understand what investing is. Gemma said today before we went live that she's spoken to 2 people this week that have said, but investing is like gambling. Investing is not like gambling.
Yeah.
So if you think investing is like gambling, that is a sign to go and read more into it.
Yeah, absolutely. So let's talk about the things that you need to consider when you're investing. So I think there's 7 main things. See if you want to add anything. So we've already talked about what I believe you need to do before. So get your cash flow sorted, have a debt payment, have an emergency fund, and have clear goals. So then when you've got all that sorted, when you're actually considering investing, the things that I think are most important is knowing what your investment goals and time frame is. So if this is money for your first home that you want to get into within 3 or 5 years, this is not investing money, right? That's when we look at cash and things like that. So these are investment goals for long-term wealth, and you've got the time frame to support an investment. And we're going to look at some graphs on why time frame is important. So what risk you're willing to take. So how much, ups and downs, and how often you'd be comfortable with a negative, really making sure the sleep at night test passes. Diversification. So looking at having different eggs in different baskets, as Lexi was explaining before, that the super funds generally do for you. The cost and the fees are really important, because depending on who you use to buy your shares through or manage your investments or whatever, there's going to be costs associated with that. There's going to be admin costs, investment costs, and maybe advice costs or something like that. Mm-hmm. The structure is really, really important as well, whether it's in your name, your partner's name, joint names, might be in a different kind of structure. So the structure and the tax kind of go hand in hand. And then the final one I would say is your plan to review it. So how often are you going to be checking it, and how often are you going to be investing? But how often are you going to be reviewing it? Because if you're the person that is going to be checking the unit prices, your share prices every single day, then you're probably not ready to invest, because that's going to make you very, very nervous. So are you going to be checking it once every 3 months or once every year? And how are you going to do that? So they're the things that I think is most important. What do you reckon?
Yeah, I would agree with that. And I think that it is a good segue into these graphs that you mentioned. So the graphs that I'm going to share on the screen are in relation to the All Ordinaries or All Ords. If you watch Sunrise or just news in general, you would see this pop up. I remember when I was like 10 years old, watching the news in the morning before school, as you do when you're 10 years old, and it would pop up All Ords, and I'm like, what the hell is that? And I think there's a lot of people in their 30s, 40s, and 50s that actually don't really understand what it is. So the All Ordinaries is what we call an index. So I guess you could say a representation of the top 500 companies in Australia. So they were some of the ones that I read out earlier. So what's first going to come up is what has happened to the All Ords in the last day. So basically since this morning, what has happened? And this is what we call the volatility. So prices have come up and they've gone down, but it kind of looks a little bit scary. And, if you put money in this morning and now it's already effectively worth less. If I zoom out, because we always say, if in doubt, zoom out, and you will understand what that means when we go through this. So if we look at the last 5 days, you can see that 5 days ago, things actually looked a bit better. It was higher. Investments were worth more.
You can see why people looking at this would go, investing is so risky, it's absolutely gambling, because that is just crazy. Like you would never get that much detail on a house, right? Like, so when people go, I trust property, is because they're not seeing that. But really, property, it's just how somebody feels about it at the time is what it's worth, right? So that would actually happen if we could map it, but you don't see that detail.
Well, I put the volatility of property and the volatility of shares over the top of each other, and they're actually really similar. So a lot of the time it's just lack of information, I guess. And, we might hear some things that give us a certain idea, like most things. What we're seeing on the screen here is 1 month period. So back on the 24th of October, things didn't look as good as what they look today. If we go out a little bit more, look at 3 months, we're actually not quite as good as we were 3 months. So if you, as Gemma said, if you're looking at your investment value every day, every week, every month, every 3 months, that can, depending on your knowledge of volatility, that can impact how you're feeling and then also what you do with your investment. Like you might absolutely freak out and sell it and you will see potentially no reason. If we go a little bit further out, this is a 6-month period. Oh, gone too far. I'll go 1 year. And you can see the ups and downs. And when they say on the news, there was like $4 billion wiped off the share market today, they never tell you there was $4 billion added to the share market today. So obviously bad news sells newspapers as well. If I go to the 5-year mark, can anyone identify, let us know in the chat, what happened here? What happened in 2020? Why did the share market drop off a cliff? So this was COVID here that happened. And you can see here, we're basically back to where we were pre-COVID. So let's say you were invested here right before COVID and you just rode it out. You didn't touch your investments. They'd be worth what they were back then. If you sold at any way down this line, you have basically lost out.
As that was plummeting, that would have just felt absolutely terrifying for so many people. And even in this period where it's been gathering, like increasing and gathering some speed, like there's sort of a roller coaster of emotions that people would have been feeling. And while we go, oh, look, it's only back to where it is, people might be going, well, that whole time in the market was wasted getting back to it. But a lot of these shares are dividend producing shares. So you might have been getting income off them the whole time, regardless if the share price was actually valued less than when it was at a different point in time. Because these are companies that are making money, like CBA and all of that, making huge end of year profits that are often shared with shareholders. So you can be getting income as well as making up money in the actual value, the capital value of the share.
Yeah. And so with investments, if you've got shares, you've got a specific number of shares. If you're in a managed fund, you've got a specific number of units. And so you always retain those same number of shares or same number of units. It's just the price of those shares or units that changes. So it's like the share price is only that on paper. You haven't actually made the loss until you sell, if you're selling at a loss. On the screen here, we have a much longer period. So what you can see on the screen at the moment is from 1999 until now, 2023. You can see COVID still, it hasn't completely disappeared, but you can see as well the global financial crisis back in 2008, 2009. So even if you were invested back then and you just rode out the volatility, we are above where we were pre-GFC. There are a lot of people freaking out, coming down this hill, and they have consequently shot themselves in the foot, I guess you could say, if they sold their investments during that time, depending on what they're invested in. And this particular chart actually goes right back to 1985. So, there are some people that started investing back here and their investments are worth significantly more now. This is why you want to be investing, so that your money is working for you rather than you working for your money.
And this is why time frame is so important, because if you had, like we gave the example before, your home loan deposit that you put in 2007 and you plan to buy a house in 2009, that's gone, right? So yeah, time frame is so important, and you shouldn't be investing anything that you have a goal for or a need for at a specific time. If it's for long term and you will buy a property or something with it, but you'll buy it when it's a good time to pull it out, and you can just keep riding it out and assessing and keeping it in there longer, as we saw that it can recover. So time frame is so important, but majority of the time you should be just investing the money that is for wealth creation, for long-term wealth, for passive income and stuff. Nothing with a specific purpose other than to give you financial freedom, choice, and all of that stuff.
Yeah, that also ties in with something called dollar cost averaging. So this is just one of those other investment basics that you're probably already doing, you just don't realize. So dollar cost averaging is when it's the opposite of timing the market, put it that way. So timing the market is trying to think like, oh, is now a good time to buy? I don't know, is the market going up or down? And sometimes you get it wrong and sometimes you get it right. But history has shown us that the alternative, which is dollar cost averaging, which is basically investing no matter what at a certain point. So like with your super contributions, they are being, depending on how often your employer is paying, doesn't matter what the share market's doing, you are investing when that money hits your account. And it's a little bit like buying fuel. So the prices go up and down, but you will get the average price if you fill up at set intervals. Anything to add to that?
Yeah, I've got a yeah, let me bring up. So it takes out the analysis paralysis. You set that every payday or every month or however often you are going to be investing in that chosen share. So you might be investing in kind of like we talked about the bucket before that's got heaps of different investments. It might be an exchange traded fund, a listed investment company or something. So you pick the share that you're going to buy, and on the same time each month or each pay, you're investing regardless. So you're not looking at, is it a good time to invest? Am I paying too much? Am I getting a deal? You're just putting them in. And then when you look back over the year or your investing journey, it might have been a good time once, then it might have been a bad time, might have been good. And it just kind of evens out. And it just meant that you were consistently doing something rather than trying to time the market. Another thing that I often hear from people that haven't started investing yet is, I don't want to invest in that share because it's not doing great at the moment. The share's down, so I don't want to put money into it, when that is exactly the time that you want to. So everybody always wants to jump into the market when it's going up because they're seeing positive things. Whereas the best time, if you think of a sale, is when things are on sale. So when now in hindsight, we can see the GFC, COVID, that was Black Friday sales in the share market. If you had bought any time then and now it's recovered, you got something on sale. So what you could have bought one of, you could have bought a few of.
Yeah. When I first started working in financial planning in 2009, I bought my first investments, and it was just a bit of fun learning as I went. And I could not have accidentally timed it better. I bought at the bottom of the market where all the prices were the lowest that they had been. And I still have those investments. So I got lucky. But as they say, the best time to start was yesterday. The second best time to start is today.
I think that on that, so another really common thing, and then we'll wrap up, but I think we've covered off everything that we wanted to. But another thing that I hear people say is, I don't want to put extra into my super, and it might be their investment or whatever, but usually it's their super because these are inexperienced investors. So I don't want to put more into my super or my investment because I'm putting more in, but the balance is not changing. It might be even going down. So that is a scary thing to do, right? And I've even, before I studied financial planning and became an advisor, I was the same. I was like, why am I constantly putting money in and this is going down? This is ridiculous. I'm throwing away money. But what's actually happening is you're buying units. So that there's the value, but there's also the units. So think of them as like blocks of money or bills, but they change in value. So I was buying lots of units really cheap. And yes, the units were getting cheaper and cheaper because the market was going down. But that meant when it went up, all those units, I had more of them and they were going to be more valuable. So that's where you get your money back. So it feels really scary to be putting money into something that you're not seeing, like a savings account. If you put $50 in each time, you see it going up by $50. Whereas an investment, you might not. So you might need to focus on the units, how many shares that you own in it, and that number going up, rather than just the value of it, because this is such a long-term thing. You want to collect the units, you want to collect the share numbers. But it can hurt seeing that happen.
We did have a few other things that we were going to talk about in terms of investment basics, things like dividends even, but we can cover that off next week. You had a resource to share today, though, for anyone who can't wait until next week and wants to learn more during the week.
Okay, so after people learn about investing, they're always kind of like, oh, where to now? Or how do I learn more? I just stumbled across the moneysmart.gov.au investor toolkit. So MoneySmart is a website that we always recommend people use for anything. It's got just so much information about finance. It's very, very user-friendly, really, really simple term. It's a great place if you're looking to check an advisor's registration, you're looking at information on super, on tax, everything. But they have what's called an investor toolkit, and you answer questions, and then it will come up with check boxes on things that you should do or links that you should read. So the Money Smart Investor Toolkit is really cool. I'll put the link in the chat now, but that's a great place for you just to play around, answer questions, have different kind of avenues, like a bit of a flow chart comes up and you can navigate through that. But there is so much information online, free courses and things. I just think it's really, really important that you assess and you know where the information's coming from, who's providing it, how up to date, current it is. This is exactly why platforms like Finito that we're on are around, right? Because they want to get content, they want to get information out to people from credible sources so that people are getting the right information. But yeah, check out the Investor Toolkit. I was pretty impressed with that when I was just playing around with it before. But let's come back next week and we'll do a part 2 of this. So if anyone has any questions or anything that they want us to cover off, just put comments under the video if you're watching it, and then we can pick them up for next week too.
Cool. See you then.